Hey everyone, thanks for joining. We'll just get started in a couple of minutes. Hey everyone, thanks for joining. Hopefully you can hear and see me okay. We should have the Xact Accounting team joining in a second. There's Phil.
Hey mate, how are you?
There's Josh. Good, mate, yourself?
Good
morning.
Good.
And Sue should be coming in. Hopefully. There we go.
Hello.
Awesome. So we've
Hi,
got
Suze.
two virtual backgrounds, two blurred backgrounds.
Yep.
Yeah,
Mix it
I'm
up.
not in the office today.
Josh has gone gets the prize for the best oversized logo on the webinar.
Oversized. Yep.
Yeah. This actually is the Build Xact office in Melbourne, but I'm not there, obviously, as you can see when it moves. So yeah. This is the office in Melbourne. Thanks for joining, guys. Really appreciate having you on. We've done a few sessions all up now. Yeah. So for everyone joining, we've got a few people in there. So just obviously make sure you shoot your questions in and whenever you have them, and we'll try and come to them as soon as we can. We'll have a questions section at the end as well. There's something I want to just start by saying. I used to work for MYB. Through my job, it was advising bookkeepers, accountants on how to run their business in terms of bringing on new clients, what clients are looking for, obviously trying to get people on MYB and things as well. But one of the things that, this is sort of going back 7-8 years now, one of the big things that a lot of people made in that space, the mistake people made in that space, was not focusing on one specific industry or area. And you kind of imagine how it works. If you're trying to run a business and you're trying to sell to 1 million different customers, you're trying to sell 1 million different types of products, that's going to be hard for you to do. Same thing in any advisory service or any other business in the world. If you try and spread yourself too thin, jack of all trades, master of none, that kind of thing, you're never going to be able to get the best of what you're trying to do. And it's the same thing with bookkeepers and accountants. If you spread really, really thin and you're doing trade and construction, clients, manufacturing, retail, hospitality, like the amount of hospitality apps there are alone, just on how to run a business to make sure wait times are done, stock management, trades and construction with different job management apps, estimating apps, Build Xact. And then that's only the sort of areas I'm touching on right now. But you think manufacturing, big inventory management systems, all those kind of things. It's impossible for an accountant or a bookkeeper to do that very, very well, unless they've got a giant team and they've got 1-2 people that deal with a specific area. But even that is really hard from a leadership perspective to try and manage that. You just really, really spread too thin. And the point I'm trying to make with saying this is, when we run these webinars at Build Xact, we try and bring in people that have expert knowledge in a particular area. So we try and bring coaches in, for example, that know building construction. We don't want people that work with people doing hospitality and how to make a restaurant successful, because they're probably not going to know the intricacies of a building construction business when, you know, you're waiting for a payment that's worth 150 grand. Like, that's not necessarily something you're going to see in a restaurant, for example. So completely different ways of working, ways of managing client advice that you can give to a client. And that's kind of where Xact Accounting come in. So specialized in construction. That's why we work so closely with them. They've been like absolutely amazing with us and helping us out and providing free advice and resources to our audience. So I'll bring in Phil first, and then maybe you want to do an introduction to your team, Phil.
Yeah, absolutely. I might. Thanks for that, Jules. We do really love working with Build Xact. You know, we're both sort of specialists in our niche. And I think that, you know, we're stronger for this kind of work and being able to work together. This, hopefully you can see my screen there.
Yeah.
Yep. Okay. So I'll just kick off. And first up, I'm going to introduce the team we've got on the show today, on the webinar today. So I'm surrounded by wonderful accountants, Suze and Josh, both chartered accountants, both partners. I'm one of the partners at Xact as well, and COO. You know, these guys really, as Jules said, really just focus on building and construction. We live and breathe it. And so the advice and expertise you've got on today's webinar, I hope you get the most out of it and ask questions throughout. Just really quickly, our services at Xact. So we do bookkeeping. Bookkeeping, as Jules was sort of touching on a little bit there, has just changed significantly over the last few years, or the last 5 years, really. Everything going into the cloud. Bookkeeping these days is as much about system integration as it is, you know, pushing the numbers around in Xero. So getting all of your platforms talking together and building out a really strong accounting workflow across your systems. So we do that as a dedicated service, and you know, obviously build Xact inside out as part of that. Compliance, so this is tax and structuring, all that good accounting stuff. This is where Suze and Josh live in our compliance divisions, and not only tax and structuring, and you know, basically how to make the most of your profit. So you make hopefully make a good profit through the year. The last thing you want to do is hand a cent more over to the tax man, as we say. So that's what Josh and Suze's mission in life is all about. But they also look after compliance around licensing. So we do a lot of work with iCare in New South Wales, with QBCC in Queensland. So any kind of compliance obligations as well, they look after that side of things too. And then finally, our CFO advisory division. So most people are pretty familiar with the Suze and Joshes of the world, the you know, tax and structuring type accountants. Not many people, though, have worked with a commercial accountant, so like a financial controller or CFO. So these guys are all about the commercial side of your business, how to improve margins, how to improve your estimating processes, all of that sort of stuff that really comes along with having a CFO. Unfortunately, the size of business, though, means often you can't afford a full-time accounting team or a CFO in your business. So these guys work with a portfolio of clients and offer that as a part-time or a fractional service, particularly for businesses that are growing. I'll take a breath there, Jules. Jules tries to remind me to have a breath, so I'm just having a breath there. Our clients, so our clients are usually scaling up. You know, they want to grow their business, and in building and construction, as we've seen over the years, there's a lot of work on. And so that's quite often, you know, who we're looking after, people are trying to manage that scale. They have a growth mindset, getting a bit hippie here, but, you know, they just want to improve themselves. They want to learn more. They want to grow their business carefully and well, and they want to level up their own expertise as they go on that journey. They recognise that it's probably time for a specialist, that the accountant they've been using for years might be a nice bloke or woman, but they might not be a specialist. You know, they might sort of have this more generalist approach, and at this point of the journey for them in their business, they think, you know, actually it's time that I use an accountant who really knows my industry. And then finally, it can be a bit lonely running a business, being the owner, being responsible for everything. And ordinarily, it's good to have a really strong finance running mate with you. So someone that you can be, you know, who's all across the numbers in your business, provide some accountability around those numbers as well, but essentially helps you on the journey from a finance perspective. So they're our clients. They're the people we love working with the most. housekeeping on this session. The agenda today, I'm going to go through a few first principles in terms of how we approach tax, and then we're going to take you on the tax journey. So this is designed so that whether you're just starting out or you're looking for sort of, more expert level tax tips, we're going to walk you through the various stages of the tax journey. We're going to run some polls throughout. So partly to make it a bit more interactive, make sure everyone's awake, but also as a way for you to access some of the resources that we're going to talk about today as well. We'll have questions. Really happy for you to drop questions as we go throughout the session. So just drop them into the chat. We're not using the Q&A feature. We're just using chat. And we'll stop at the end of this handful of sections that we'll stop and we'll take questions on the material we've just covered to break it up a bit. There are no silly questions. We want you to be vulnerable and ask whatever question is on your mind. Josh and Suze are real experts. Don't walk away from this session having not asked that question that you really would like the answer to. We are happy to take really complex questions as well, but this is a fairly general session today. Some of those more complex questions rely on specific information that might not be best shared on a session like this. So we're happy to kind of take that stuff offline if we feel like it's starting to get into too much of the nitty gritty. And then finally, we've got an ebook available. Some of you may have seen it, but we'll be getting that out to everyone who's registered today. It builds on the content that we're going to cover off on today, so you can have that sort of as a resource to follow up after the session. So Jules, I might just throw it back to you. Did you want to, it'd be good to sort of know what everyone's wanting to get out of the session today, yeah?
Yeah. So we'll start with where everyone actually is based in the country. If you guys can all pop in your chat, and obviously just for us to make sure you can hear us okay and the chat's all working. We did one of these before and Phil forgot to turn on the chat, so
and he'll never forgive me for it, will you, Jules?
No. And there's another one in the slide here that he might not have changed either, that I'll have a little bit of a laugh at him for later on. So quick, Brisbane's a lot, which I expected from you guys, being in Queensland as well. Brisbane,
Tassie.
Coast.
Jackie's in Tassie.
Right, yeah, Tassie. Stuart from IBM is in Melbourne.
Kate's in New Zealand.
We are lucky to have New Zealand. Fantastic.
Sussex Inlet, lovely part of the world. Yeah,
awesome.
Down
Brilliant.
the south coast, New South Wales.
It's obviously working. Just when you guys are actually popping in the chat, just make sure you change the little drop down.
Yeah, I just picked that up too, Jules.
Yeah, to everyone. So that means everyone can see where. Some people still put hosts and panelists, which is fine. We can see it. Just
we can see it. No one else can. Yeah.
And just so we know where you are. What are you looking to get out of it? Is it trying to find what the new laws are and how it relates to construction businesses? Is it, you're working from home and you want to figure out how that stuff works, what you can claim, what you can get away with claiming, maybe? Pop that in the chat if you can, guys, as well. That'd be appreciated.
I want to buy it. Should I buy it now? Should I buy it next year? Can I write it off all at once? Yeah,
I'm sure.
If there's something specific that you're after today, it'd be good to find out so we can make sure we cover off on that.
I'm sure everyone here is wanting to buy an electric ute. That's why you want to find out how that works, right? Is that the?
Yeah. Well, I see the Cybertruck's been delayed again. Sorry, Jules. I know you're waiting for that Tesla Cybertruck to come out.
I don't really like them, to be honest. I feel like they look a bit.
They're a bit strange. They're very strange. Yeah, Maxine saying, usually let the accountant do all the work, but I just want to understand the basics. Yeah, yes, the accountant's got to do a lot of the work, but part of today is about trying to, level up your own knowledge so that you can be an active partner in that conversation. Unfortunately, not all accountants are as proactive as they could be. And so we're kind of trying to get people to know what questions to ask, know what areas to kind of go into, so they can, have an active relationship there. Best possible tax strategy to reduce unnecessary money to the government. I completely agree, Jackie. is what Josh and Suze live for.
Yeah.
Okay.
Stuart's put in there how many homes can builders build before the ATO wake up to CGT?
Yes. Yeah. Well, Suze is going to cover off on that. We've got a specific section on property development and CGT implications. So, yeah, we'll be covering that. Okay.
Brilliant. I think we've got a good overview there. I think most of that is covered. But obviously, guys, keep your questions coming in. Obviously, the more we can kind of tailor it to people, then the better. But you're not going to get any tax advice or any opinions on tax from me because I don't have a Scooby-Doo about that, which, if you know Cockney rhyming slang, that means clue. So I'll leave it to the team here and I will turn my camera off and you won't hear from me just for a little bit until Bill calls me back in.
Awesome. Thanks, Jules.
Brilliant.
Let's get cracking. So before we begin officially, this is a disclaimer slide to say that really we're providing general information here today. We haven't taken your specific circumstances into consideration, obviously. And we've also, we've got some examples we use along the way. We've tried to simplify the examples so that they're easier to communicate from a concept and principles perspective. So really always, though, before you make any decisions about this sort of stuff, make sure you consult accountant, lawyer, whoever the professional service is that needs to be involved in that. In terms of so before we begin part two, at Xact, we try and balance a few things. So one of those balancing acts is tax strategy versus commercial strategy. So we might see an opportunity for a tax savings, but we're looking at the commercial side of your business as well. And if it doesn't make sense, I mentioned buying a ute earlier on, if it doesn't make sense from a cash flow perspective for you to buy a new car, then we'll advise against it. So we're not just going to be looking at what the tax strategy side of things is. We do try and balance it out with what's happening in your business as well, and that's really critical. The other thing is we balance between what's available to us from a tax opportunity perspective and what's legal. So unfortunately, it's not how everyone works in this space. If you're on this webinar today to find an accountant who's just going to turn the other way and do dodgy stuff, that is not us. We want to take our clients right to the edge of the line in terms of what they can save under tax law and the regulations, and make sure they get the best possible result. But we don't want them to be waking up one morning to an audit, which can happen. The ATO's data matching is getting better and better. And it's just not a way to live your life to be worried about this sort of stuff. So that's another balancing act that we've got in play. I mentioned this a little bit before. We reckon that tax is all about you and your accountant. So working proactively with your accountant. You've tried to build this profit through the year. So what is it that you can do to make sure that you hang on to as much of that as possible? Our team over the last couple of months really now has been working feverishly with our clients to put together the tax plans that they need to have in place to work out exactly how things need to land for the year. And that's the way it should be. You really should be working proactively with your accountant to make sure you get the best possible result. That is it. We're going to go through, in terms of first principles, in terms of this tax journey, we're going to go through newbie. So we're going to cover off on a lot of the tax basics that really everyone should be making sure they're managing properly. We're going to go through then for those businesses who are starting to get there. So you've probably been trading for a while now and starting to, turn a bit of an okay profit. So what are the things we can do from a structuring perspective? Some of those sort of higher order things that we can look at. And then finally, we're going to cover off on nailing it for those businesses who are doing really well and want to make sure that they're not paying more tax than they really want to. Often that involves more complex structuring advice. You might be into some property development by now. and things like self-managed super funds, that sort of stuff. So we're going to kind of go the journey here. At this point, I'm going to bring in our. One last thing. We're going to also cover off at the end. If you are on fire from a tax perspective, that's an ambulance chasing the people who are in the fire. If you're on fire from a tax perspective, you've got an ATO debt that might be problematic. We're going to cover off on that as well. So hopefully no one on this call is in that situation. But if you do have a considerable tax debt or debts generally that you need to deal with, there's some pretty good legislation around for that these days. So we're going to cover off on that quickly as well. Okay, we are moving on. So our first section is newbies, and Suze is going to cover off on that, starting with structure. Over to you, Suze.
Thank you, Phil. So welcome everyone to the webinar today. It is a real pleasure to have you all here with us, as everyone has already said. So on with the newbies, and what we typically find with structure in this space is you will either be operating as a sole trader or potentially as a company, although that is not as common, we find, at this newbie level. This is typically where you're just starting out. You might be on your own, or you might have one subby working with you. And we often will see one of these two options, sole trader or company. The pros and cons, as you can see there on the screen, sole trader is very simple to set up. You literally go, register your ABN, and off you go. If you're working with your accountant at this level, they will often recommend that you have a separate bank account set up as a sole trader. That's purely just to track the difference between what's your business income and expenses versus personal income and expenses. And that can be quite important when it comes to deciphering for tax what is deductible expenditure versus what is non-deductible, as in personal. If you are trading in a company or you're looking at that, one of the big issues or big pros in this space is asset protection. So if you've got your own house, it's in your name, and you want to keep that separate from your business assets in case something were to go wrong with the business, a company is the best way to help protect you in that space. And it gives you all of those sorts of other things. The other main benefit with the company is the tax rate. Where you're operating as a company, the tax rate is a flat 25%, whereas operating as a sole trader, you're on normal marginal tax rates, which means the more income you're earning or the higher your profits are, the more tax you're likely to be paying as well. So if you're up in that 150, 180,000 tax bracket in terms of your net profits on your business, you're likely paying tax around that 45%. And so a company may be a better option for you. This is something to consider. There's a few things that would be worth discussing with your accountant in terms of, is it time for me to operate as a company? And we'll talk more about that later. Or is it worth the effort and the hassle of registering a company? Getting the asset protection could be a big part of that, and having those conversations. We do occasionally see in this space people operating as partnerships as well, but that is less common these days. And there are a number of reasons why we tend to steer away from partnerships a little bit. It is a little bit similar to your sole trader issues. There's no asset protection in that space, and you've got marginal tax rates that you're dealing with. But largely, that's where you will find most of your operating from a structuring perspective. From a technological perspective, Josh is going to chime in and have a bit of a chat about what you might be doing software-wise.
Yeah, absolutely. Thanks, Suze, and welcome everyone. Yeah, in the same vein, let's talk about setup. One of the key things that we want to talk about is tech stack and data flow. So we have a preferred sort of best practice stack, and basically you're trying to cover from three pillars of data collection, job management, job costing estimating, as well as the financial part of the business as well, which is where everything sort of lands ultimately. So this is our best practice stack that we subscribe with, working with Xact, Xero, and Dext. So really high level. Dext is a sort of a receipt capture software, and it is a way to capture the receipts. You know, you might get your fuel receipt, you take photos of it, and it can flow into the system. The key part of the tech stack environment that we want to sort of highlight today is that you need to make sure that whatever you're using, this is our preferred one, but they just need to be connected to each other. So we need to be using connected software stack that actually talk to each other in a sort of more appropriate way rather than sort of disjointed information. So an example of this stack we've got here is Dext, as an example, can capture data. It flows into Xero. BuildXact has spent a lot of time and energy building a two-way sync with Xero now to make the data much more user-friendly between there. And the key thing is capturing your cost data properly against your budget so that you can make sure that your jobs are actually on track or not. And then fundamentally, what you're trying to do is use a dynamic tech stack to actually give you some reporting that you can use to actually make decisions properly in your business, how everything's flowing. Now, the only caveat to setting up a tech stack is what we see, and we see this very commonly, is whilst these softwares are interconnected, they do require a little bit of setup, and you need to be aware of how the interactions work, because they, out of the box, they talk to each other, but you do need to finesse a little bit. And I know our bookkeeping team has spent a lot of time working with clients connecting this stack in best practice way. So if you're already using this stack or thinking about what sort of stack to use, this one we spent a lot of time working with BuildXact and Xero and setting this up. So we can help anyone set up best practice stack as well. So that's a key part of what we work on as well. So Phil, did you have any, or Jules, did you want to add anything to that?
There was a question at the beginning there around, cash flow around BAS payments and things like that. I mean, I think if you've got a really rock solid process in place, you've got you've made life easier for yourself in terms of capturing invoices without, manual entry or that sort of stuff. You're using something like Dext to make your life easier. And you're reconciling, weekly at least. Then really the BAS shouldn't be a surprise from a cash flow perspective. You should really be able to see that, very starkly, very clearly what that number is going to be.
Yeah, and Xero has a dashboard as well, Phil. The dashboard.
Yeah, I was going to say same on the BuildXact side of things. If you've got all of your invoices coming into Xero properly, and then you've got a two-way sync set up into BuildXact, you should then be able to match that invoice against the job in BuildXact so that you can start to track how each job is going from a cost perspective, and therefore, are you on track to make the margins that you need to, that you set out to make for that particular job as well? So we sort of put this reporting piece down the bottom here, but there's a lot of really excellent reporting that comes out of BuildXact now from an accounting perspective as well. But like Josh said, you do need to have all this stitched together properly and talking to each other properly so that you can, have that really great, efficient workflow in place.
Yeah, and just to add to that as well, like one of the things that I would say to businesses is get this bit sorted out so early on if you can, because although and there is obviously a thing with extra subscriptions, and I understand that I've got Xero, I've got bills, I've got to pay for something else, and I understand that can be a thing to use different softwares and stuff, but a lot of the times you can get people like Xact Accounting to take a lot of that stress out, so you're not actually having to be inside constantly using different things and having to do big giant learning on every single little platform that you have to use. And kind of what it does is that we see people a lot of the times where they'll have every intention to go in and start coding transactions and start doing all of this stuff. And what happens is you end up having to do a few quotes. So you start working a bit later. You've got to balance the family, the kids, the social life, whatever you want to do on top of that, on site all day, all those kind of things. What tends to get delayed is, I'll enter those bills in later. I'll enter those bills in later. And before you know it, you're a month, 2 months down the line, you're losing money in a job. You don't know that's the case. You haven't used that time to, negotiate, I don't know, longer payment terms or trying to win money back on the project or just make some changes in the business. And you may have even estimated new projects on bad data that has now gone up in price and you haven't updated, all those kind of things, right? So the sooner you get this stuff up and running, you ideally take the responsibility of doing it to someone else and managing the whole lot for you. And it just speeds everything up, keeps you more accurate. You know exactly where you're at any point in time, rather than having to do all that data stuff yourself.
Yeah, I just see Kat has put a note in there about, we're just about to flash up a poll about, I guess, if anyone wants help stitching these platforms together so that you can exploit the reporting functions either inside Xero or in Build Xact. We're happy to do a separate session on this. I mean, we kind of bring it up today. We're talking about tax, but really this is so foundational from a commercial perspective, but also from a tax perspective, because it just makes everyone's life a lot easier to see how you're traveling, where you're at, if you've got all of your accounts in order. Even things like having a good chart of accounts set up. So, you know, you don't have 1,000 different accounts in there. You can see things quite clearly. So yeah, we're happy to offer a separate session on that just to help you out in terms of putting all this together so you can get that reporting that you need.
Do you want me to throw that poll up now, Phil? Or
yeah, let's go.
Yeah.
If you want, yeah. So this poll that Jules is about to launch is really just if you want to hand, from an integration perspective. Yeah, someone's mentioned HubDoc there. So HubDoc is another option as well as Dext. We prefer Dext because you can allocate the jobs. And the AI is better. Our bookkeeping team tell us that the AI is better in Dext as well. It's just better at recognizing which account those costs should be coded to, and it remembers it, and so it's got some better predictive technology in place. But yeah, please, if you want to have a hand with any of that sort of tech stack stuff, let us know and we'll reach out for a chat. Okay, let's move on. We got quite a bit of content to go here, so our hosts are going to smash through here. Hold on, people, because we're going to fly. Let's go. Suze, you're up. We're talking about purchasing a vehicle.
Yeah, one of the big questions we get, particularly this time of year, and particularly with the whole immediate asset write-off or immediate deduction that you could have claimed in prior years, is what about vehicles? Can I go and buy myself a vehicle, and can I get a tax deduction for it? So we're going to hook into some information about vehicles now. One thing to keep in mind, there are some thresholds with vehicles in relation to tax and other types of tax, like it says here, luxury vehicle or luxury car tax. That's actually a tax imposed by the government at dealer level. If your vehicle costs more than $79,000 and something, I think it's $650, you will be charged vehicle luxury tax. Luxury car tax. And that's, as I said, imposed at the dealer level. So that will be added as your purchase price when you go and buy a vehicle. There is a depreciation limit as well. It's not on all vehicles, but on most vehicles. That limit is sitting around $68,000 and something, $781 or somewhere around there. And again, what that means is that you can actually only claim a deduction up to that limit on a vehicle. So even if your vehicle costs you $120,000, you're capped at that $68,000 odd for tax purposes in terms of your deduction amount. So just be mindful of that. There are some exemptions and certain vehicles that are outside of that. Largely that relates to commercial vehicles. Things like loaders and forklifts and those sorts of things can be exempt, and some types of utes can also be exempt, but there are specific criteria around that. So it's always important to just have a chat, work out if the vehicle that you're looking to buy is exempt or not, and what that tax implications might be in relation to that. In terms of GST on your vehicles, you're also capped in a line with the depreciation limit as well. So your GST claim that you can make on a vehicle is around about $6,500, somewhere about that limit. So just be mindful of those couple of things when we're doing vehicles. Now, I've got an example coming through, and a lot of people these days looking to buy a Hilux. We've put one in here just to go through some numbers and show you how this all works. We've said the vehicle price or driveway price for the vehicle is $59.74, and we're saying that we think we can depreciate it over about 4 years. Now, the instant asset write-off is gone. That is no longer applicable. So you can only now apply depreciation. So what that means is that $59.74 is able to be claimed over a 4-year period, a portion each year, which gives you roughly $11,600 as a tax deduction each year over those 4 years. And a GST credit on that of 1/11 of your purchase price, thereabouts. There's a couple of little bits and pieces that might change that very slightly, but largely that's where that lands. So in terms of how we claim the deductions on vehicles, If you're operating as a sole trader, your options are cents per kilometre or logbook method. Your cents per kilometre is capped at 5,000 kilometres per year. And that's very important to note as builders and tradies, because often you're doing far more than that in terms of kilometres on an annual basis. Often we'll see 20, 25,000 kilometres a year is quite normal because you're driving between work sites frequently. So if you're only using cents per kilometre, you're capped at 5,000 kilometres. The rest of your kilometres don't count, basically. The rate that's set at the moment is 85 cents per kilometre. So your maximum claim available to you under this method is $4,250. You can't claim anything in addition for depreciation or any of those sorts of things. That's it, just that amount there. If instead you looked at the logbook method, and you must keep a logbook for a minimum consecutive 12-week period, that logbook can start anytime really, and applies for a 5-year period. So you don't need to redo it unless your pattern of usage has changed a fair bit in that period. So what does that mean? That means if we've done that, we've looked at and done our 12-week logbook, we've come out and we've just assumed here an 85% work-related usage pattern on the vehicle. We've laid out some expenses here, so fuel 5,000, rego 1,000, etc. That means your total costs on the vehicle is 23,600. Applying 85% as work-related means your claim for tax is actually $20,060, a fair bit more than if we were using cents per kilometre and only getting the 4,250. So you're saving here roughly $9,500 of tax just by making sure you've got your logbook in place. Now, if you're in a company, this doesn't change much. You should still keep your logbook. Look at that option, and there's a couple of other things which kick into play, but largely your logbook has to be your main source of reference in terms of what we're looking at for a claim under motor vehicle expenses. We've made a couple of assumptions there, but largely that's where it sits. So Josh is going to talk us through home office for a bit.
Excellent. Thanks, Suze. There's a lot happening in the car space still. Now, home office, let's decode home office expenses because this has been a little confusing over the last few years. And there are sort of 3 core pillars to how the home office claim works. It is actually sort of similar to vehicles. So the sort of basic one is a fixed rate, similar to cents per kilometre. It's basically a fixed rate per hour claim type. The extension that is then an actual cost method. So you've kept receipts, essentially type like a logbook style as well, to claim home office in that way. And then there is an extension to both of those 2 limbs, the fixed rate and actual cost, which is the occupancy. And I'll try and unpack that one a little bit as well, because it's a little quirkier than you might think. So let's start with just unpacking the fixed rate. Simplest form is, I see, 67 cents per hour. And it's an all-encompassing rate as well for home office. So it incorporates internet, phone, energy, printing, all of those sort of costs as part of it. And it's just built into the rate. And really, quite simply, you just need to keep a record of the actual hours you're spending working from home. But this doesn't require a dedicated space. The fixed rate, you could be working from the couch, and that's why it's just built into an all-encompassing rate, just to keep things simple. The only thing with that is there is any assets that you buy, like desks, chairs, etc. They can be claimed under depreciation in addition to the cents per hour. So if it's under 300, you can claim an immediate deduction for that asset. If it's over 300, you get to claim it over time, depending on what it is. So that's the fixed rate method, quite simply. Now, actual cost. This isn't particularly more complicated. It's just more record keeping around the actual cost method. So really what we're getting at with actual costs is you need to keep the receipts for your actual costs incurred. And this is where you have a dedicated space in the house. And it doesn't mean that it can't be used for other purposes, but it's really at this one place, an office space in your home that you would use to work from home. And so you want to keep receipts around internet, phone, energy, printing. The only quirk to the actual cost method is that it's sort of you calculate it based on a units per work hour basis. So the starting point is you do need to keep a logbook for a continuous 4-week period, or you keep a detailed log of all hours. And then you apply that sort of work hours percentage across the actual units. So energy as an example, right, the electricity, it's measured on units, kilowatts, and so basically you use your work hours calculated times by the units incurred on your energy bill, and that's the claim you can use. And that's similar to phone, itemized phone, internet, etc. Now the real strange one is cleaning is calculated on a square meter basis. So if you use a cleaner for your home, and you've got this dedicated space in your house for home office, then it's basically a proportion on the square meter. So that proportion of that room as a proportion of the whole home, and that's how you can claim the cleaning. Similar to the fixed rate, the depreciation on desks, chairs, etc. as well, same idea. If it's over 300, you claim it over time. If it's less than 300, you get an immediate claim. So that's the fixed rate and actual cost. Now, the extension to these two claims is what we call the occupancy cost, and it actually can apply in addition to both of those two first claim types. Now, the occupancy has a bit more of a strict requirement around actually being able to claim it. So this is where you do not have any other place of work. So you don't have an office that you can go to. Your home is basically the only place that you can do work from. And the key thing is that you really do need to have a dedicated space. So it's one of those scenarios where it's a room in the house, or it might even be an extension of the house, where basically you go in there, do work in there, and at the end of the day, you close the door, lock it, and don't use it for any other purpose, right? Which is sort of a little restrictive. So it is a square meter type arrangement in terms of how you claim the proportioning of cost, but basically occupancy now starts to bring in things like your mortgage, interest. If you're renting, it'd be the rent, the council rates, water rates, land taxes, all those other home operating costs. But the key thing we want to flag around this is it can impact your main residence exemption. So a really quick sidebar on this, because it's a bit of a misconception on capital gains tax and in your home. So all property actually, when you sell it, is actually within the capital gains tax regime. So by default, if you sell your home, it is actually subject to capital gains. However, we actually apply an exemption called the main residence exemption, which is why we don't typically pay tax on our home when we sell it. So the key thing around this is you do need to make sure that you have a good think about whether you should or should not claim this cost, because it could impact the application of the main residence exemption. So, and I can see Esther's making this point as well. You do need to be very careful if you want to go down the track of claiming those costs, but there is that requirement that you must not have any other place of work. So you do need to get some advice from a tax advisor. You do need to weigh up the pros and cons of occupancy, but if you don't want to claim the occupancy, you still do have either fixed rate or actual cost under home office. Now, goodness, that was a big unpack of home office. If anyone has any more questions around it, feel free to jump in. We do unpack this a little bit in our ebook as well, but home office is surprisingly more complicated than you might think. So yeah, I might hand to you now, Suze. Bad debts.
Yeah, so this is a really good time of year to review where you're at with your accounts receivable. So anything you've invoiced your customers and they may not have paid you, unfortunately. So a couple of key things to remember with bad debts. If you want to write it off, and as we said, it's a good time to review that, because writing it off gives you that deduction now for that. You want to make sure that the actual amount that's owing to you is older than 12 months. You want to make sure you've actually made a reasonable attempt to recover the money in the past and they're still not paying. And, you know, it could be quite significant. We've seen instances where builders have invoiced and not been able to recover, and it could be $20,000, $30,000, $40,000 worth of invoices that are sitting there. Now, often a common question we're asked is, if I write off the bad debt now, what happens if they do eventually pay? Well, conversely, you've got to bring it back in as income. So it is always good to have a look at it, good to consider whether it's worth writing them off now, but do keep in mind that if they do pay, say, next year in 3 months, 4 months, 6 months, you might have to bring that back in as reportable income in the next financial year. But definitely worth reviewing, going through and having a look at those sorts of things. Kat's just asked a quick question there. What evidence is needed for reasonable attempt? Great question, Kat. I think largely you need to make sure if you've got a debtors policy in place, you've followed that policy. That might be a phone call when it's 14 days overdue. It might be a letter at 30 days overdue. It could be that you've pushed it to debt collection and that's not recovered yet. Really, there's no real definition of what's reasonable attempt. It's simply that you've made an effort to actually recover the debt and have not been able to. And the first point we've got there, typically older than 12 months, is a good indication that you've tried. It's been sitting there, you've chased it, but it's still not been paid. It's a good indication it's not going to be paid. So that tends to be where we sit in that space. And I think we're over to a quick poll.
Yep. So we're going to, I'll just skip through the next slide here. One of the things that we often come across, and is quite, unfortunately, quite a confusing area in construction accounting, is WIP, work in progress. It's not really a subject that we would usually touch on in the tax world because it's not taxable. And so that's probably the biggest thing we wanted to sort of point out, that people shouldn't be confused or concerned about WIP sitting there as a taxable item. It's not. The other thing though is that we know that there's a lot of confusion about WIP, how to calculate it, what does it mean? It really does have a big implication in terms of being able to have proper visibility on your profit. If you're not calculating WIP on a monthly basis and feeding that into your accounts, it is very hard with income and costs going in and out in a very lumpy way, like we have in project accounting, to normalise that and actually see how your profit is travelling month in, month out. You can't do that without having WIP in play and being accurate with WIP. So we built out a calculator on WIP. So if you would like, Jules, if you could just throw that poll up at this point for WIP. If you wanted to get hold of that WIP calculator, it's very easy to drive. And the link that we'll send out to you has a video from another webinar that we did on a deep dive to calculate WIP. We're actually rerunning that webinar early next month. So if you'd like to join us on that webinar as well, we can send you out the details and you can join that webinar. It'll be another interactive session like this. So that is that. Thanks, Jules. I think we're going to push on now to our next section, which is...
Phil, I just wanted to mention we've got a few questions coming through in chat. We're not
going
to get to all of them as we go, but we will have a question session where we'll pick up any that we've missed as we've gone, and we will get to your questions and answer them as we come through into those sections.
Great idea. Yeah, I think we'll try and pick up those as a batch once we get to the end of this section, because we're just about done with newbies.
Yeah, a couple of quick hygiene bits. Two quick hygiene bits. One thing, it might sound quite simple, but it is often overlooked around actually provisioning for your tax. So not waiting until you get a tax bill and then going, oh, okay, I'm going to need to find the cash flow to actually pay for it. So the key thing is, it is looking at regular financial reviews of your business and actually being aware, working with your accountant, using your software stack properly, making sure the data is clean to actually get a picture of your business and how you're tracking, how you're accumulating tax, both it could be GST, the employee tax, and the actual business tax itself on profits. The simplest way to deal with this is actually set up a separate tax savings account, separate to your trading account. It's a bit of a forced physical move of money, which is a good way to visualize putting it aside. Working with your accountant, definitely pre-30 June is a core thing. We're doing a lot of that work right now, and also looking forward into the next year. The best thing you could do is work with your accountant, look at your business, and do a bit of a schedule for the next 12 months. It might not be perfect, but it'll give you an idea of the sort of tax that and when it's going to be due for payment as well. And Xero can very much help with this. The dashboard, you can also do some clever stuff with the dashboard to help keep track of it. But the key thing is just actually think about it, set it aside, and don't wait till you actually need to pay it to work out where you're funding it from. Now, there is a best practice way of doing this. A real simple form of boiling it down is you could just set aside 3% of your gross revenue monthly. That's gets you pretty close. It's not going to be a perfect metric that we're using there, but the 3%, when Suze and I sort of spoke about it, we thought, 3% probably gets you there pretty close most of the time based on your gross revenue. So that's provisioning for tax. We do have...
I think we use that. I mean, obviously, like I said at the beginning, everyone's circumstances are different. So, you need to have some science in play. But this was partly for people who are starting out, because we're at the newbie stage here, and we're looking at what the standard margins are in the residential building sector. And then, from a GP perspective, 20 to 25%, and then 10% falling out the bottom, hopefully single digit overhead figures. So we thought that 3% of gross revenue would be not a bad guide. If you don't have a good tax plan in place, or you don't have a lot of back data to base it on, that would be not a bad place to start. Your next one here, Josh, is another one to remember.
Yeah, a quick one. Staff super. At its simplest form, it's not deductible unless it's paid on time. So just remembering that super is at a minimum due to be paid quarterly, and it's due by the 28th day of the month following the end of each quarter. So this quarter, for example, you must pay your super by the 28th of July. The key thing around this, whilst software is fantastic these days, you do need to be aware that there is some clearing time with clearinghouses. So don't always wait till the 28th of each month to pay it. Xero, as an example, will want you to be doing that a few days out from the due date so that it gets through the clearinghouse. So particularly if you're trying to pay super early this year, if you want the tax deduction this year, because it's only tax deductible when you actually pay it, make sure that you're pushing it early. I know Xero wants you to be basically pushing it yesterday, today, if you want to make sure that you get your staff super deduction in on time this year.
Righto. So that is actually, that's the end of our kind of newbie section. There was that question from Ingrid. Great to see you again, Ingrid. Regular caller. Are defects repaired tax / repairs tax deductible?
Yes, is the bottom line.
Yeah, good answer is yes. I think we understand the context that you're asking that in, but yes.
Okay, and then Ben, I reckon I've got a knack for this. I reckon Ben's an accountant. Can fees incurred chasing the debt be included in the bad debt?
Yeah, that's a good question, and it a little bit comes back to your policy. So some businesses will actually on charge the debt collection fee with the debt to the customer and recover it that way. Absolutely, the debt incurred or the fees incurred in chasing the debt are deductible to the business. They are fees that are associated with your income producing activities and getting paid and those sorts of things. Yeah. So yes, I guess it's a twofold question. You can claim the deduction or the expense of the bad debt chasing as a deduction, and you could also on charge it if you wanted to the business or to the customer as well.
Yeah, it's linked to the ordinary course of business. That's the cool part.
Yeah. Okay, so did we have any others? I think we'd answered the rest of those sort of along the way. So we might, if it's okay, unless there are any other questions that relate to any of that kind of, cars, home, office, bad debts, etc., we might just move on now to our next section, which is getting there. And this is for people who are, I guess, now starting to turn a bit of profit. So we don't want to hand any more of that over than we want to. So Suze, take us through structure.
Yeah, so this is where we start seeing people looking at alternative structures. So if you've been trading as a sole trader, you might be considering, could I get a better tax outcome if I look at a company? Should I be looking at a trust? What options do I have when it comes to structuring in this space? And absolutely, we see a lot of people move towards companies at this level, particularly if you're operating in Queensland. QBCC prefers companies over trusts. Other states, we do still see trusts operating the business and being your trading entity. So it doesn't really matter which way you're running in that space. Both structures will get you similar outcomes. An example we're about to run through. So for example, a very simple one, we've got 600,000 of revenue generated by a business, whether it's a company or trust. We're saying we've got 300,000 in direct expenses, which leaves us 300,000 left in terms of profit and covering other costs. We were going to pay 100,000 of that to the owner. leaving, and another 200,000 as operating expenses. So if you go through all those numbers, basically it's going to leave us round about 100,000 profit. Now, a couple of options you've got in how we deal with that profit. If you're in a company structure, you must pay 25% of that profit as tax, which means a $25,000 tax bill effectively. If you're in a trust, that profit needs to be allocated somewhere to a beneficiary, and the beneficiary then would be subject to tax on that money. Now, in this simple example, we've got if we've already given 100,000 to the owner, if the partner then is to take the balance of the profit of the 100,000, we've got 100 in each hand, and we're both paying tax at that 100 level. If the company has paid the tax on that profit and we move it via a trust distribution to the partner, we've also got a tax credit that could potentially flow with that. Now, that can get very complicated. It's really worth going through with an accountant to understand if you're not quite sure where we're going with this at the moment. But on our next slide, we've got an example of how the tax would fall out under those scenarios. So if you were a sole trader, we had the 100,000 of owner's wages assigned to you, plus the 100,000 of the profit from the business. That would mean you're paying around about $65,000 in tax. If instead you were flipped into a company trust structure where you can share that income with a partner, we would end up having a situation, as I said before, where both parties have 100,000 of income in their hands. And the tax on that, though, sits just under 50,000. So you actually would save yourself nearly $15,000 of tax if you can run more in a company and trust structure than as a sole trader on that scenario. So there's definitely opportunity to have a look at where this restructuring when you get to this stage of your business is worth it, not just from an asset protection, also from a tax and effectiveness across the family group strategy. So a few things to have a think about and have a chat there in relation to. Now, one of the questions we still get asked is about trusts. And there are some crackdowns coming down. ATO's been making a bit of noise about this over the last couple of years. What we see is trusts can still be a very effective vehicle for tax purposes. Again, it depends on how you're doing that. Adult children is where the biggest issue is coming from. So what the ATO doesn't like is where you say, I'm going to take $100,000 of profit and give that to my 20-year-old daughter who happens to just be at university and not doing anything else, but I'm going to keep that money myself. So all I'm doing is passing that money to her for a tax reason. That's what the ATO doesn't like. There are some ways we can get around that a little bit, get around it. It's not really getting around, it's being reasonable within the law. And that is if we are providing benefit and that benefit is being derived by the adult child. For example, we had to buy her a car. She couldn't get to uni without the car. So we're going to take the cost of the car as a trust distribution to her for tax purposes, and she's going to use that money to buy the car. So she's deriving a direct benefit from that distribution. We're not trying to put money on her that's really sitting in my pocket for my own benefit. So that's where the ATO is getting a little bit antsy with a few of those situations. Again, if you've got trusts, if you're looking at these structures, it's definitely worth having that conversation with your accountant. One of the other big issues is 7A, and Josh is going to talk us through some of those issues now.
Yeah, so the structuring with a company is fantastic, but there is something you need to be aware of around companies. Is in the first instance, the money that the company makes is actually the company's money. So companies are their own separate legal and tax identity. So the profit you make, you pay 25% tax. Fundamentally, until you are pulling that out as either a dividend, it really is the company's money. So a very common thing we see with companies is the company makes the profit and the money's pulled out of the company, which creates a director loan or a Division 7A loan owing to the company. And so the whole point of Division 7A is to basically say, well, the company's paid a low tax rate, but you've used the money. So ultimately, we want the shareholders or individuals to be paying tax at their marginal rate. Now, it's not like it's all doom and gloom with Division 7A. There are positives to it as well, and they can be used very strategically. But the first sort of principle is that the loan coming out of the company in the first instance doesn't attract an immediate tax problem necessarily. So it does require some good planning, working with your tax accountant around it, but it doesn't trigger tax straight out of the gates. But the requirement is it must be repaid, including interest. Now, the ATO post an interest rate, benchmark interest rate, they call it, of 8.27%. So basically, you pull the money out, and the ATO wants you to pay it back over 7 years, typically with interest. The interest is actually accessible to the company. Depending on what you use the money for, the interest may be an actual tax deduction on the other side, but we won't dive into that because that might be unpacking something a bit too complicated. But the ways to actually pay the loan back are quite simple. So one way is you can transfer the money back to the company. Honestly, that's pretty impractical for most people because you've spent the money typically. So instead of looking at the alternatives, or how do we pay it back? So the other way is actually declaring wages to the person who turned out, to the director or the shareholder. And part of that wage, rather than taking the money, the wage just gets assigned to the loan to reduce the loan balance. The key thing with wages, though, is all wages typically will attract some sort of superannuation. So that's, but it's still possible. You might want to actually do that. Wages are one way. The other way, and reflecting back on Suze's example as well, is actually declare a dividend out of the company. If you've got it structured in the right way, you could strategically have that dividend in a lower sort of tax environment and essentially pay the loan back over the 7 years. So Division 7A, it's one thing, just be aware of it. Just with companies, if you've got a company and you're making profits and you're pulling the money out, it's not as simple as that. Just make sure you've got some good tax planning. So we've done a quick case study around Division 7A and when it might be actually useful to do this. So say John's company has a really great year. We've got a bunch of cash in there. We're paying our requisite tax on it as well. But unfortunately, the family car has packed it in and it has broken down and you're looking at buying a new one. So it's a bit of a juggling act of working out what are our personal borrowing rates looking like. So personal loan from a bank or even finance company versus should I use the excess cash in my company to do this? So you might find that the personal loan rates could be higher than the 8.27% rate that the company requires under Division 7A. So we might take the loan from the company and we're going to pay it back over 7 years. And there's multiple ways you could pay it back. You could pay it back like an ordinary sort of loan and just put the money back into the company, or actually start paying the tax by declaring the dividend or the wage, as I was suggesting. And the good thing is the 7 years sort of pretty much aligns with what most vehicle funding is anyway, if you're using a personal loan or a car loan, which are typically are 7 years. So that's an example of how you could use it strategically, but again, it just requires some really careful planning around it. Make sure that you don't fall foul or get trapped by Division 7A.
Yeah, and look, we see these come into the business completely are a complete mess often.
Yeah.
You know,
Awful.
they've been used, the client doesn't understand how Div 7A works. They haven't been attended to properly. And so it takes quite a lot of mental gymnastics to then, iron things out. And so I guess Josh is just making the point that it is a viable option, but it just needs to be used properly. And you as business owners, it really pays to be across those directors' loans and how that works. So make sure you take the time to understand it. There's Serena questions here on question. That. Getting there. Ben, I think we probably just needed a little bit more detail there. What about transferring assets to the company, like cars, etc.? I'm sure there are a whole range of reasons why you'd want to do that. I know in QBCC land, if we're looking to improve the balance sheet, that's often something that we might need to do.
You might replace the cash. So if you've taken a loan out of the company and you have to repay it back, but you've actually got the best thing is probably unencumbered vehicles. Isn't that example? It's something that doesn't have a loan on it. Yes, you could tip it back in as a replacement. Cars are a tricky one, aren't they? So if you put a car in there that's a luxury car or a car that's not used for business, you'll shoot yourself in the foot, because then there's this, we're not going to talk about it today, but there's fringe benefits that then starts kicking in, which then could cause a whole host of problems for you. So just you be careful.
And then if Ben's question is about, if you're moving from being a sole trader to a company and you've got assets under the sole trader, how do you get them into the company? Yeah. That's a whole other kettle of fish. So there's quite a number of different options you've got in relation to that, to move assets across from you as a sole trader into you as a company. So That's a big can of worms there that we could get
but
in
importantly,
the whole webinar on.
But importantly, it needs to be done sometimes, and so it's just, again, it's about how you go about that and doing it properly, so that you get the outcome that you're after, rather than unintended tax consequence of not handling that properly.
Yeah.
Ben's asking, what age will my child become viable to enter the trust?
Yeah,
18.
you use the key word viable, Ben. Well, kids generally, you can distribute up to $416 if your child's under 18 as a trust distribution, but typically it's 18 when you sort of adult taxing. 18 is when they become viable. But an interesting thing, I might just plant the seed, if you do actually have a child under 18 and perhaps they might have a disability as well, there are some actual things you can do there around disability trust, etc. as well. So it very much depends on your circumstances.
And the other thing to, I suppose, be aware of there is, are you dealing with what we call discretionary trust, or so often known as family trust, or are we dealing with a unit trust? So that's going to give different outcomes, whether your child is viable to enter the trust or not. And most families' trusts will have provision for children to be incorporated in the trust from the outset of the trust, whether the child is born or not yet. So it just really depends on what you're trying to achieve with that. But Josh's point there about them turning 18 is a big one in terms of tax rates.
When should you start applying all these tips and tricks, in June or earlier? We would say earlier.
Earlier, don't wait till June, please, Noreen, please.
And this is part of our negotiation with Julian to try and get webinars on dates that we need to make sure that they come in early enough for people to make decisions on things. You still have time for a lot of this stuff. But you really, really need to start. Josh, when you're working with a client from a tax planning perspective, because you obviously got to try and predict where things are going to land reliably. So what time frame are you looking at there?
You want to look at how early. It's not like we want to rush around in the last few months. Actually, tax planning is an ongoing evolution. So you'll obviously look at minimizing for a year and tips and tricks for a year, but we should always be having that discussion. And Susan and I are doing this right now in the thick of it, of what's next year look like, where our strategy is from 1 July for next year's tax. And then basically, this is the strategy we want to run for the year, and then touch base again in sort of April, May, to start making sure that the strategy that we planned early on in the piece is still playing out, and we just do some another sort of finessing with it. But the key thing, it's an ongoing evolution, and basically straight from the beginning of the year, you need to be thinking about the strategy.
And it depends on what you're doing as well. You might have a project coming up. It's better to always have that conversation before you commit to the project than it is when you're 3/4 through or even finished it, to work out what the tax outcome is going to be.
That's right.
So it's always best to have those conversations when you're looking at it from the beginning, rather than 3/4 of the way through or at the end or whatever. So yes, planning is always ongoing. Depends whether it's a project, depends whether it's a general business sense of planning, or other bits and pieces like that.
If you have investments,
again, with that relationship with the accountant, like
Absolutely.
that, like so often we get a client, I've bought a car, now what do I do? Call us before you buy the car, and let's talk
selling
about what the best way to go is there.
I was mid-meeting yesterday with a client, and we were talking around what was sort of in the next year, and they sort of come up going, oh, look, we might sell this investment property next year. I'm like, right, that triggers an enormous gain and there's some tax. Oh, what do you mean? I'm glad you asked me, because we're talking hundreds of thousands of dollars here. So I said, now we need to really start playing. So it's one of those things that we have a lot of conversation with our clients and get really close to them. You should have a really close relationship with your accountant, because you need to be able to share that information willingly with us, because the planning all starts from knowing this information as early as possible.
Jules, you've put your video on. That often means you wanted to jump in on something. Are you?
No, I was just in case you wanted me to ask the questions that were coming in, but you were doing a great job, so I just.
Thank you so much, Jules. Okay, I think that's it for that section. We're doing our last section now, which is nailing it. And so, wow, we're turning over a great profit now. The tax man's coming for us. We want to try and do everything we can here to set ourselves up, often at this point, for the long term. for even potentially what's happening in after work phase in retirement. So let's kick off with that. Josh, you're up first with superannuation.
Let's jump into superannuation. This is my favourite area. I love super. It is a good long-term planning strategy. So let's just unpack what super contributions mean, what's possible, what sort of benefits you get. So there's two key buckets of super contributions, money that you can put into your superannuation. And quite simply, one is before tax or tax deductible, and one is after tax. And those two words are concessional is the tax deductible and non-concessional is after tax. So let's unpack concessional contributions quickly first. So these are the contributions that you either have on wages, so your employer super contributions, the super guaranteed, the 11% or 11.5% from 1 July, and any other contributions you put in where you wish to claim a tax deduction. It's all under one cap, called the concessional contributions cap. It is $27,500 for this year. It's going to $30,000 next year. And so that's the contribution cap sort of annually that you can put in. That's basically where you're getting a tax benefit for it. Now, the last few years, from sort of 2019 onwards, there's been a carry forward concessional contribution. So this is where in the earlier years, where the cap was 25,000, it's been 27.5 for the last couple of years. If you haven't used your entire concessional contributions cap, the unused element can be carried forward for a period of 5 years. Now, the key eligibility is that your total super balance has to be less than 500,000 as a sort of first tick to get out of the gates on it. And there are some age limits, but we'll just talk about the high level on it. So assuming you haven't used your cap in some of those earlier years, and you may have carried forward 10,000, 15,000, it could be a scenario where using the carry forward, particularly if you've had a great year this year, the carry forward might be eligible to get circa 60,000 into super and actually claim a tax deduction for it. So the carry forward does require a bit of sort of looking at what's eligible, how much you've got, and obviously there's a bit of a cash flow planning element to it as well, because obviously you're putting money into super. For most people, you're not going to be getting your hands on it for quite a long time, but it is a good planning strategy for the future. Non-concessional as well is where you may have sort of accumulated a pool of other money. You may have even had an inheritance or a gift or something like that, and you sort of want to top up your super to make sure that it's on track to sort of help support you in retirement. So the non-concessional contributions cap being 110,000, 120 next year, and it's an ability to get a fair bit of money into super if that's your strategy. The key thing I need to sort of flag is don't just be throwing money into super without having a strategy. You need to talk to a financial advisor to make sure that there's a clear strategy around why you're doing it. The other part of non-concessional, similar to carry forward, but in the reverse, you might want to put in a decent amount in 1 year. And so what you can do is you can bring forward the next 2 years contribution caps to this year. So rather than 110, you put in 330. It does lock you out for the next 2 years. So you can't make any more non-concessional contributions in the next 2 years. But it is an ability, if the strategy makes sense and it's overall part of retirement strategy, to get a decent amount of money in. If you've got a husband and wife that are trying to do this, you can end up pooling quite a substantial amount of money for your retirement. Now, structuring. This is a really interesting area. Susan and I spent a lot of time in the structuring, around complex structuring. And there's a few reasons why you might build a complex structure around your group. And what we're talking about is using different sort of tax or legal entities for different reasons. So when is this a thing? Well, when there's a lot of healthy profits being generated, there's a core part of wanting to protect them. You may also be looking at sort of property developments, and there's also retirement and succession planning reasons. Now, in terms of why you would do this, as I mentioned, there's a bit of a risk mitigation element to this. So what you're trying to do is not have all your eggs in one basket concept. So you need to make sure that we're mitigating risk. Property development, building construction are pretty high risk games. You just need to make sure that all this hard-earned money, wealth that you're creating doesn't get jeopardized if something happens, touch wood, with anything to do with the business or a property development. And it's also a way of creating investment wealth in lower tax rates as well by using companies in a strategic way as a long-term planning strategy. And in a lot of cases, the structuring that we need to do is there to also comply with some of our regulatory requirements, like your ICARES, your QBCCs. You do need to be careful around planning for that. And the QBCC example is because revenue, it's based on a revenue calculation. If you've got all sorts of revenue property development, you could end up having trouble meeting some of the financial requirements if you're pulling everything. So it's all around just separating risk and being able to create wealth in a strategic way. Now, there's a few different ways you can structure. This is a bit of a visual representation of a few different examples, structures. I'm not going to talk through every single one of them and why we use it, but all I'm sort of trying to highlight with this is you can use various different structures for different reasons, like property development, segmenting that risk, the main trading entity. You can use a sort of stack of these together. The key thing is it's talking with the likes of Susan, myself, looking at what you're trying to achieve. It's a long-term thing, structures, and it's something that needs to be considered really early in the piece. You don't want to wait too late to do structure because you may end up having trouble unwinding anything later on with tax implications potentially, or even stamp duty implications if you don't get it quite right. But one of those things to keep front of mind on getting the structure right. Now, property dev, you deep dive into property development now, Suze, talking about structure.
Yeah. I don't know about deep dive, but we'll certainly touch on it. It's certainly one of those things that when businesses and builders start nailing it in this space, it's one of the things that really just happens. Everyone seems to start dabbling in this area. And there's so many different options that are available to you in this space that why wouldn't you? Why wouldn't, when you've got the skills and the expertise and you understand building and property and that industry, why wouldn't you start moving into that? So a couple of key things to look at when you're looking at property development. It's not always clear, easily clear, whether it's income generating or whether it's capital assets. And there are different tax consequences depending on which one it might actually end up being. So I guess right from the outset, the big thing is, and we've said it so many times, get advice. Get advice right from the outset when you're thinking about a project. What does it look like? What are you intending to do with the project? Because that could have a very different tax outcome to what you're thinking initially, and could sway whether that's actually a reasonable project to go ahead with. No one wants the tax implications to blow out in these scenarios and wreck your profits that you're looking at from that perspective. Phil's just chimed in.
Yeah, sorry, just quickly, the difference between capital investment and income generating, just in case we're using terminology there. Yeah.
Yeah, so normally with capital investment, you're looking at something that you would buy and hold for the long term. So you buy a property, you might rent it out, you might live in it, but your intention is not to sell it in the short term. So short term, we're talking 1 to 3 years, really. But it could be more than that. It depends. But really, we're looking at a long-term type of investment. You're buying it to hold it and sell it in the long-term future to get capital growth out of the asset. Income generating is more, and we've got a few examples coming up on the next slide, more where you're looking at a shorter term type of turnaround on a project. So a good example is a flipper. You buy the property, you do a bit of a reno on it, and then you sell it 6 to 12 months later, depending on when you finalize your renovations. Those sorts of shorter term projects where you're really in it just for a quick cash grab, they tend to be income generating. Now, it's not always that clear cut. There are instances, and we had this question earlier. I can't remember who asked it now, but I know it was there, about how many times can you do this before the ATO? Thank you, Josh. Yeah. How many times can you do this before the ATO picks it up as potentially either being CGT or not CGT? So I think where the initial question was coming from was, if we do that type of project, we buy it, we reno it, we sell it, but we're living in it, so we're treating it as our main residence. When it's main residence, it could be exempt from capital gains tax. So how many times can you do that before the ATO picks up? It may not be. It's not really clear. 2 or 3 times when the ATO starts to see a pattern, they will tend to say, actually, it doesn't even fall into capital gains necessarily. It could jump straight back into income generating. That means all of the profit on the project could be subject to tax at the end of the project. So it's very, very specific to each type of project that you're running, what your intentions are with the project, and then, you know, having those conversations early. Sometimes intentions can change. That can also change tax outcomes as well. So it's important to get the right advice around these sorts of things. GST is a bit tricky in this space. And a lot of times we don't realize GST could apply to your project. And there are instances where it absolutely will apply. And there are instances where it's maybe. And there are instances where, no, it's not going to apply at all. So again, GST could have a very big bearing on whether your project is viable or not. So very important to get advice there. And then the last one we've got on this slide is CGT main residence. We've touched on it already. And Josh mentioned it earlier. Your house that you live in actually is subject to CGT under the tax rules. It's an exemption that gives you non-taxing outcomes in relation to your main residence. It's not actually the other way around. So we always start with the assumption that a property is taxable. Then we've got to look at whether an exemption applies, and that's one of those. Some examples that we have in relation to property development. We talked about flipping already. Other options you've got is splitting. This is another common one we see. People will buy a large block of land. It might already even have a house on it. And you split the block into 2, 3, or multiple land lots, and then either sell them as vacant land, or you might build and then sell. So there's things that a lot of people are doing in that space as well.
I think we've got a question exactly on that. So it's from Jackie. How do you decide on purpose for a multi-dwelling development? So 2 times townhouses, one to be sold as soon as completed. Often people will do that, and one to be held for a longer term, possibly rented or occupied by the owners of the development. That sounds like another accounting question, I reckon.
Yeah, so it's a good question, because that is another common one where people will look at a property and say, look, I'll split it into, keep one and sell the other. And in some cases, there's really good options for you. That's what we would refer to as a split purpose for tax. And it would have to actually, the costs would then be split based often on square area of the land. And you would have to split your purpose across those 2 lots when you eventually split it, if it's 2, or it could be, as you've got there, 3. You've got 2 townhouses, one's going to be sold, one's, so it depends on, again, the circumstances, but we end up with a situation where we've got a split purpose and different tax outcomes depending on which property is dealt with in which way, if that kind of makes sense.
So again, you don't want to kind of be trying to retrofit a tax position on that. You need to go into 100%. That development very clear on how it's all going to be handled.
Yeah, absolutely. And it's this kind of situation where a lot of people walking into these, they go, it looks great on the surface. Once you start doing some numbers and running through scenarios, what you actually think you're going to do with it, you can get very different profitable outcomes on that, depending on what your tax implications could be. So it is very important to run your numbers at the start and the viability of your project, because you might find that, okay, I'm starting with it as being a flipper. I want to buy, reno, and sell. But when you run the numbers, you go, oh, actually, I think it might work better if I buy and hold and rent it out. So you could have different options depending on how you run your numbers at the start. And if you don't get your tax implications correct from the beginning, you could find yourself having made the wrong decision on a project just because the tax implications destroy all the profit that you had sitting there. So yeah, plenty of different options and scenarios, 2 packs, 3 packs, etc. Share housing is another big one that we're finding these days. A lot of people are looking at that as an option. NDIS housing as well is coming up more and more. A big one to think about if you're doing these sorts of projects is when you're doing small versus major renovations. The law actually calls it significant renovations, and there's different tax outcomes, different GST outcomes, whether it is a small reno or a significant improvement on the property. It's another quick question here from Stuart. If you were to build 2, one for yourself and the other for the SMSF, do you need to create a bare trust before you can start construction? Can you do it automatically, or is the end value an issue? I think that's a question for Josh.
Susan's showing that to me. Well, the bare trust thing is really very much dependent on if you're borrowing to do it. It is possible to borrow to do off the plan building with SMSF. The key thing you do need to be mindful of is whether the funder wants to do it in the first place. Because you're a related party building, obviously you need to be very careful around creating arm's length contract. There's nothing to say you can't do it, but it has to be arm's length. You do have to tick a lot of boxes around it. It's not necessarily Can you do it automatically? It just depends on how you are structuring it and whether the super fund can pay for it in the first place. The short answer is it can actually get borrowings under a bare trust arrangement. Whenever you're borrowing, you must have a bare trust to do off the plan construction. It is possible.
And that is where we're going to leave that one, because I think that's starting to get right into the weeds.
The weeds.
Yeah,
And I think
we might unpack SMSF now as we go, Phil.
Yeah, that's right.
Straight into it. So self-managed, this is the obligatory disclaimer, so we'll leave that there for a quick moment. The key thing is it is a financial product, superannuation, even self-managed super, so it is squarely in the financial advice regime. So make sure that it is right for you before you go ahead and do it. But let's just unpack high level self-managed super. What is it? Why? It's attractive. So it's really taking.
Sorry, Josh, we are coming up on time too. So
yeah, I'm just going to run through it quickly. So this is you taking the reins for your super. Be mindful you're then taking control of your retirement funds as well. If you're doing self-managed, it's very common for the use of commercial to buy commercial premises. These days, there's a lot of rules around it. Our ebook actually covers off on this a bit better as well. So I would refer to our ebook. You can borrow under super, which we sort of started quickly unpacking with Stuart then, but it has to be done in a specific way. Why is super so attractive? The tax rate is very concessional. So any earnings in super, 15%. Any capital gains made on investments in super, the tax rate is 10%. In retirement, the tax rate can be even as low as 0. So that's why it's such an attractive thing. Here's a quick example. So say you use a self-managed fund to buy a commercial or business premises, an office, and your building company rents it. You have to be careful, make sure it's at arm's length. So get a third party, depending on how the rent is to be determined, put it in a proper lease. But fundamentally, you pay the rent from your company, your building company, pay it to the super fund, and you're basically taking that money out of a higher tax environment, 25% minimum or plus, and putting it into a low tax environment. So immediately there's a potential tax saving in this scenario. Say the rent's a 50K number of 5K. But the real cool part to it is you're doing it so that you're growing your own valuable investment. So you're doing it so that you're paying rent really to yourself for your retirement. So it is a great strategy. It's not for everyone. Lots of things to tick the box on before you do it. But that's a quick high-level unpack of super. Look at the ebook for the LRBA stuff.
We very, very quickly, because we are essentially out of time, I mentioned we're going to talk about if you have any issue with your tax debt, there's an option available, really not just for ATO debt, but generally for unsecured creditors. This small business restructuring process, it's a bit of legislation that came out as a result of COVID. To take advantage of this option, you need to have unsecured creditors of under $1 million. So if you've got over $1 million in debt, it's not an option. Your super has to be up to date. Otherwise, it's not on the table. The upside of this compared to other options in terms of insolvency, etc., you don't have to hand control over to a liquidator, so you remain in control of the business. You can keep trading. Ultimately, though, you end up making an offer to your creditors. Over 50% of the creditors have to agree to it. But we have found, through contracts that have gone wrong, because of price increases and those sorts of things, that in the end, a lot of people ended up just not keeping up to date with their ATO payments. And so they end up with this sort of, 300,000, 400,000, 500,000 in debt to the ATO. At the moment, the ATO have been agreeing to these arrangements, and anywhere in the order of 20 to 30 cents in the dollar as a deal. And the other upside is in Queensland is that if you are operating in Queensland, you have to be very careful with your license with the QBCC around insolvency events. The QBCC don't see SBRP as an insolvency event. They will, however, probably ask for an MFR report at the end to make sure that you're still meeting their minimum financial requirements. So please be very careful if you're operating in that sort of legislative arrangement. that is it. We're just going to quickly mention a free ebook that's out now, and we're going to send everyone a link that's registered to that ebook. Jules, if you're still alive, if you're there still, we haven't put you to sleep with tax.
Still
Could
here.
you just throw up the last poll? This last poll is we've got some slots available with Josh and Suze. If you did want to have some time with us or with Julian and his team at Build Xact, if there's anything that we've touched on today that you'd love to sort of unpack further, again, with your specific circumstances, we'd love to hear from you. We do have some slots available over the coming couple of weeks. So reach out and we'll get in touch and try and set up a time to catch up. I think we're right sort of just over time now. We're happy, I think, just to hang on for a little bit longer if anyone has any further questions. But if you do feel like you've got to be somewhere else now and you're going to go your merry way, then we're fine with that. We'll send a video from today out along with the links to the things we've talked about and the results from those polls as well. Jules, did you want to add anything in closing there?
No, I mean, you guys covered a lot of it. So yeah, nothing specifically from me. Just obviously thank you for jumping on, and yeah, thanks to everyone else that jumped on and joined on the session. And most people stay to the very end, so that's always a good sign. Yeah, great, really good audience, some good questions in there as well. And yeah, I guess the biggest call to action would be don't be a passenger with this stuff. I know people kind of freak out a bit or kind of get confused with tax, but we would really recommend trying to lean in a bit more and understand it, and really, that's the role of your accountant as well, is trying to educate you. Unfortunately, there's a bit of a dynamic where the accountant kind of holds the keys to the universe. Really, it shouldn't be like that. They should be spending time with you to help you understand what's going on, what sort of arrangements you're going to be putting in place, because this is your life, right? So it's important that you are active in that. Yeah, and I think from what I got as well is that don't necessarily leave it until June next year to do this. Do have a plan throughout the whole year. My voice is going as well. Yeah, absolutely. It's a year-round thing. So please, get involved. Yeah. Righto. Lovely. Awesome. I don't think there's any other questions, so we might sign off. There's a couple in there about where to send links to Bill, which I think you should be able to grab that afterwards from the chat, right? Or do you need to take these details now? Yeah, we've got the chat, so we can send that out, but we'll certainly be sending a follow-up email anyway with a link to the webinar and how to get in contact with us as well. So, if there's anything specifically that you want to come back to us on, you can do so afterwards. Brilliant. Lovely. Awesome. Yes, so Noreen, you're going to get that ebook. Don't worry. It's coming your way. You won't miss the ebook. If you have children, you'll be reading it to them as bedtime stories, no doubt. Okay. All right. Thanks, Jules. Thanks, guys. Thanks, everyone. Thanks, everyone. Thanks, everyone. We'll see you next time. See you for the webinar. Bye. Bye.